If I lost everything tomorrow, there are a few huge lessons that over 25 years of stock market experience has taught me, often the hard way, that guarantee that I would still retire with millions. Now, you might think I'd look to find deeply undervalued stocks, but I'd actually keep it a little simpler. I'd focus on buying just 3 ETFs. Now, today I'm going to show you which ones I would choose, why they work so well, and how they can help you build long-term wealth. Now, listen. I completely get why most people overcomplicate investing. There's just always so much noise out there. There's stock tips, AI news, crypto, and the experts are constantly claiming each one will be the next big thing. But the reality is, building wealth rarely works when it's complicated. Oftentimes, the best portfolio are the simplest portfolios. They don't require you to check the market every day. They don't rely on perfect timing entries and miraculous exit. And most importantly, they're built on a foundation of logic and discipline, not emotion. And that's why today's video isn't about finding the next Tesla or trying to guess the top sector in 2026. It's about showing you the exact 3 ETFs that I would personally buy if I was starting today and how they'll help you build a low-stress, high-conviction portfolio that lets you sleep soundly at night. Now, guys, I want you to know, of these 3 ETFs, I currently dollar cost average into one of them, and the other 2 I will in some point in the future, even as I buy individual stocks. I don't look at them as mutually exclusive. I look at it and say, I can buy individual stocks and I can buy ETFs. So let's quickly talk about what an ETF is and why I believe they're one of the best investing tools out there today. An ETF stands for an exchange-traded fund. It's basically a collection of stocks that you can buy with just one click. It trades like a stock, but inside of it, it holds a diversified group of companies. Now, you've probably heard of mutual funds, especially from your financial advisor, which is very similar. ETFs are similar, but far more financially efficient. So why exactly are they better? They are low cost, and they don't require active management like mutual funds. There's no fund manager trying to beat the market with stock picking, and ironically, that's exactly the reason why ETFs often beat mutual funds, especially over long periods of time. In fact, most people don't even realize that the vast majority of actively managed funds, even the expensive ones run by those Wall Street pros that went to Harvard, underperform the simple, low-cost ETFs that we're talking about today. Buffett has said this for years. For 99% of people, the best thing you can do is buy a low-cost S&P 500 index fund and keep adding to it over your lifetime. Buffett's so confident in that advice that he's literally instructed his estate, his own family, that when they inherit his money, to invest in low-cost S&P 500 index. Now, are there people who can and should pick individual stocks? Absolutely. We've interviewed many of them on our channel, and along with myself, there are many members of our community who've done very well investing in individual stocks over a long period of time. But that takes discipline, that takes patience, and it takes a process grounded in logic and valuation. If you don't have those skills yet, or don't have the time to spend, ETFs are going to be your new best friend. And as you invest in those ETFs, you can learn to buy those individual stocks slowly in your portfolio. So with that in mind, let's get into the first ETF I'd buy if I were starting over today. VOO or SPY. Now, VOO is the Vanguard S&P 500 ETF, and it tracks the 500 largest, most established companies in the United States of America. We're talking about companies like Apple, Microsoft, Google, Coca-Cola, even Berkshire Hathaway. These businesses are the backbone of the American economy. And here's the kicker. It does all of this for an expense ratio of just 0.03%. That means for every $10,000 you invest in VOO, you ready for this? You're paying $3 per year in fees. Try finding a mutual fund charging that. For the same $10,000, the average mutual fund's probably going to charge you between $75 and $150 per year. So let's go a little deeper and what makes VOO so powerful. So first, it's diversified by default. You're not betting on a single company to do well. You're betting on American capitalism. You're saying, I believe that the largest companies in the US will continue to innovate, will continue to grow, and deliver returns over the next 20 or 30 years. Now, historically, that has been a pretty darn good bet. Second, this ETF is passively managed. So there's no emotional decision-making, no one trying to outsmart the market. Oh, this company looks weak, let's sell it. No. This means you're not going to make the mistakes of selling a great business too early or buying a loser at the peak. You just get the market return. And over the long term, that has proven to beat over 90% of professional fund managers. In fact, I see studies that say it beats over 98% of those Harvard MBA fund managers. Third, It's about a battle tested as they come. The S&P 500 has gone through the dot-com burst, the financial crisis, assassinations, world wars, pandemics, inflation, interest rate hikes, everything you can imagine. And it's going to continue to go. Will it have its up and downs? Of course. That's what markets do. But historically, long-term investors in this ETF have been rewarded big time as long as they stick with it. And this is exactly why it's important to dollar cost average. Instead of trying to time the market, waiting for that perfect day to invest, you simply invest a fixed amount of money on a regular schedule, no matter what the market is doing. That could be weekly, bi-weekly, monthly, quarterly, whatever it is. For example, putting $500 in your ETF portfolio on the first of every month. Have it just be pulled out of your account, boom, just like that. All my stepkids, all my grandkids, that's exactly what we have done, pulled in automatically. Now, sometimes you'll buy when prices are really high, and sometimes you'll buy when prices are really low. But over time, this strategy smooths out your purchase price and reduces your risk of making the wrong investment at the wrong time. It takes the emotion out of it, which for many investors is the big thing holding them back from building wealth. So guys, I've done this chart before. This is the market's value over time, but this is the price over time. With dollar cost averaging, you're overpaying sometimes and you're underpaying sometimes. But over a long period of time, you're paying exactly what the market would do. That's how you're going to win. Now, I don't want you to think that VOO or SPY is some magic unicorn. The S&P 500 can and will go through very large drops at times. And also remember that when I say drops, I don't mean 5 to 10%. I mean major pullbacks, 30, 40, 50% or more. But all you need to understand is that over 10, 20, or 30 years, it has been one of the most consistent paths to wealth. The longer you look out, the better it does. That's why Buffett loves it. That's why I love it. In fact, if you just put money into VOO regularly, reinvest the dividends, and ignore all the noise, you'd probably do better than over 95% of people trying to outsmart the market. Plus, there are other options, like the one I said from SPY, which do the same thing. It all comes down to your preference. Okay, ETF number 2. Now, this one gives us a different lens, one focused on income and quality. This is SCHD, and this is the one I am buying consistently right now. But it doesn't mean you should go buy it. And I don't buy it for the same reason that all those other Twitter and Instagram dividend investors buy it for. Yes, I do buy it for its dividend. That's because my state in life right now really values that income stream. I have apartments, I have businesses that all are building wealth and generating income. For me, I don't need to make 20% returns to be able to retire. All I need to do is consistently save, buy good assets at good prices, and I will do well. SCHD is the Schwab US Dividend Equity ETF. And what makes it so powerful is that it's laser focused on high quality dividend paying companies. We're talking about businesses with strong cash flow, solid balance sheets, and a long track record of paying and growing their dividends. This isn't just yield chasing, guys. It's disciplined investing at the ETF level. The fund only includes companies with at least 10 years of consistent dividend payments, but then goes further, filtering for quality and financial strength. SCHD uses fundamental screeners such as cash flow to debt ratio, return on equity, and dividend growth rate to build this portfolio. Guys, you're not just getting high yield. You're getting high quality businesses behind those high yields. Because remember, a lot of companies will want you to chase them by offering a high yield that they can't afford. So what companies are we talking about? Pepsi, Cisco, Lockheed Martin, Chevron. Those are the few of the names out there. These are businesses that are probably not going anywhere for a very long time. And the actual dividend yield, it currently sits at about 3.8%. That means for every $10,000 you invest, you'll receive $380 per year in dividends. Not bad, right? Especially considering the Fed is lowering interest rates and short-term treasuries are no longer providing that 4 or 5% that we get just a few years ago. And here's the real bonus. SCHD has grown its dividend every single year since it launched in 2011. So not only are you getting cash in your account, but you're building a growing income stream over time. In addition, the expense ratio is just 0.06%. That's $6 per year in every $10,000 invested. Yes, it's double VOO, but that doesn't matter. It's just such a small amount of money. Guys, there are companies charging 20, 40 times that for far worse performance over time. And this is exactly the kind of vehicle that I love for myself in my situation. Low cost, high quality, consistent performance, no gimmicks. Now, another important point on SCHD, the dividends give you options. You can reinvest them. You can take them as income to live off of. That's a big part of why I own SCHD. Monish Prabrai, who's a friend of the channel, talks about the fact that at certain levels of wealth, trying to optimize for highest returns actually becomes detrimental. The reality is that I have 1,000 apartments upstairs. I have multiple businesses. SCHD allows me to use my capital to provide consistent cash flow each month that I use to live off of. That way I never take money out of businesses and real estate that I can keep compounding on. So do you see why that works for me? Now, if you're a 30-year-old person out there who's just starting your career, like I see on Twitter and Instagram, and they're like, I'm an SCHD investor. I'm like, I get it, but I think you're young enough to be a little bit more aggressive. But if it works for you, it works for you. This is the option that I have, and for me in my life, this is what works for me right now. I want to touch on one other important point to make sure you guys understand this. You need to get out of your head that you're a dividend investor. Everyone loves receiving dividends. Warren Buffett does it. I'm guilty of it. The feeling is great because that money can't be taken away from me. The second it's in my account, it doesn't matter if the stock falls, I keep that money. That being said, dividends are the last resort with cash flow, in my opinion, not the first one. Dividends are tax inefficient. Before a dividend is paid, the company's already paid income tax on that money. Then when they pay it to you in a dividend, you pay tax again on it. It's a big reason why I get really upset when people say, oh, dividends only taxed at I'm like, yeah, because they've already been taxed before, you greedy assholes. And the funny part is, I like the way Costco does it for their big dividend. Every so often they say, you know what? We're going to pay this big $30 dividend out. That's what I like. When I look at individual companies, I would much rather see the companies reinvest back in the business, buy back cheap shares, pay down debt, or make good acquisitions. Now, for those of you who are looking for a little more growth, we're not done. This is the final piece of this portfolio, one that brings in a very different element. ETF number 3. You ready for this one? QQQ. Now, QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. And guess what? It includes a lot of tech. Microsoft, NVIDIA, Amazon, Meta, Palantir. Basically, it's the engine driving modern innovation. The companies that have consistently found ways to redefine the global economy over the last 20 years. Now you might be thinking, wait, Paul, didn't we already get those companies in VOO? Yes, but not in the same way. In VOO, leading tech companies are a piece of the pie, but they're part of a broader mix. You've got banks, industrials, energy, healthcare, utilities, all this stuff. In QQQ, tech and growth dominate heavily. So if you want holdings that lean into where innovation is happening, AI, cloud, computing, and more importantly, whatever technology we don't see in the future that's going to change the world, this ETF gives you that exposure immediately. And historically, QQQ has absolutely crushed it. Since inception, the QQQ has delivered an average annual return of over 10%. That includes some painful drawdowns, but in that same period, the S&P has done significantly lower, around 7 or 7.5%. But guess what? Over the long haul, you're buying great companies, high returns on capital with amazing growth rates at very little cost. You're getting exposure to companies that have generated the highest returns here. Now, obviously, if you pay a high price, it can hurt you, but not if you dollar cost average. Because remember, dollar cost averaging is what's going to save you. QQQ is far more volatile than VOO or SCHD. It is heavily weighted towards a handful of companies that lead the market up, that will also lead the market down. The reality is, if tech gets hit, QQQ is going to feel it a lot more. We saw it in 2022. We had a 20% drawdown on the S&P 500. QQQ was down way over 30%. But this is exactly what's going to be your benefit on QQQ in the long run. Now, here's why dollar cost averaging is important. March of 2000 was the peak of the tech bubble. If you started buying QQQ on that very day, you would have seen QQQ fall 80%. But if you dollar cost average all the way down to today, 14.5% plus annual returns. If QQQ falls 60% tomorrow, it's still 10% plus annualized returns, starting at the peak. That's why QQQ is so great. And their expense ratio, low, much higher than the other two, but it's about 0.2%. But you're getting a lot more return for it if you're able to stick with it. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days, you'll see. This isn't gambling, it's common sense. Now guys, we've covered our 3 ETFs, SCHD, VOO, QQQ. So let's zoom out for a second. What makes this combination so beautiful is how they work together. VOO brings balance. It's the steady ship that keeps you riding the wave of overall US economy, which over long periods of time will provide you with a 9 or 10% return. SCHD adds stability and income in great companies. When the market gets choppy and we see serious corrections, stable dividends will help to smooth the otherwise bumpy ride, and these companies tend to be less overpriced, so it probably won't drop as much. QQQ gives you the increased exposure to the most innovative companies in the world. When tech runs, it runs, and it runs in every cycle. We've seen this countless times. QQQ could help pull your overall returns much higher than the market over long periods of time. Individually, each of these is great, but when you combine them, that's where I believe the magic starts to happen. Now, guys, for me personally, I will have a mix of all 3 of these ETFs in my portfolio at some point. For QQQ, I'm going to wait for a major pullback because I just see the valuations and I'm just not willing to touch it. But that's me. Again, if you dollar cost average starting at the peak, you probably do pretty well. But the key here is everybody's situation is different. If you're 60 or 65 and you want to go all in on QQQ, probably not a good idea. If you're in your 20s and you like this process, and especially if you have a tax-efficient account like a 401k or IRA where you can get those dividends and you get them tax-free, might be a good option for you. The mix you pick is really important for you to understand and get an idea of. People in our community are always talking about this. So guys, this is how you put it all together. This is our retirement calculator, which I love. I even do for myself all the time. I'm putting an example in here. I don't know who this is, but it might relate to some people here. Age 30, wants to retire at 65, currently has $100,000 in savings. They're going to save $10,000 a year, and they're going to increase that savings by 4% per year. So this year, $10,000, then $10,400, then $10,816, or whatever it is over here. They're going to get annualized returns of 9%. That's just putting one ETF, and that's it, the S&P 500. 7% returns during retirement, and they think they're going to live to 95 with 3.5% inflation, and their income is currently 75 grand, and in retirement, it's going to go up, by the way, 3.5% a year, but in retirement, they want 100% of their income. Guess what, guys? We have enough for retirement. We hit the generate button. At 65, you retire with about $5.8 million, and at death, you retire with about $9 million. Not bad. Now, if we're able to put all of these together and increase our returns with QQQ and other things about 1 or 1.5%, here's the difference. I'm going to go to 10.5%. Now, during retirement, I'm going to assume still the same 7% return because of the fact that you'll probably pull back your high-tech returns. But look at the difference. Instead of having $5.8 million in retirement, you have $8.6 million in retirement. Instead of dying with around $9 million, you die with $30 million. Not bad. Now, $30 million at the age of 95 is $3.2 million today. But the point is, it's a good way to sit there. And these are all assumptions I'm making, but they're not crazy assumptions if you're able to be disciplined and if you're able to invest more if stocks are undervalued. So we just covered a lot. Now you see why Warren Buffett recommends that 99% of investors simply buy the index year in, year out, ignore the noise around you. I remember an interview with Buffett where he talked about everything that has happened in his investing lifetime. He bought his first stock at age 11, which was Citi's Service Preferred. Since then, we've seen World War II, atomic bombs, Cold War, Vietnam War, stagflation, Watergate, dot-com bubble, presidential assassination attempts, financial crisis, pandemic, and yet $1,000 invested in 1942 in the pits of World War II would have grown to over $11 million today without adding any more money. And now, do you really wonder why Warren Buffett gives the advice he does? Guys, this is a very simple portfolio, but it's so incredibly powerful. And if I were starting over from scratch in 2026 with nothing but time and discipline, this 3 ETF mix is exactly where I would start to consistently dollar cost average week in and week out. A strategy like this is so important for making sure you retire with more than what you need. Now, guys, I mentioned earlier that a select few have what it takes to invest in individual stocks and outperform the market over long periods of time. If you want to learn more about that process, I have built a detailed course that will help you make sure that you aren't leaving potential returns on the table. Follow the link, and I'll see you there.